Okay, so we talk about audit planning, understanding the client and risks and responding to those risks. This is chapter 6. And full disclosure, I actually did chapter 7 lecture before I did chapter 6. So if I am talking about stuff in 7 that was mentioned here, my apologies. I just did them backwards. So anyway, we talk about obtaining clients. And one of the things that they talk about in the book that is so important is engagement risk. And the engagement risk is the risk that you will engage with a client as an auditor that is going to go either A, have some sort of management problem, some sort of misappropriation of assets, or eventually goes bankrupt. And bankruptcy can happen for many different reasons, but one that we don't want to be associated with is bankruptcy from mismanagement. So you do have a responsibility to the clients are interviewing you, but you're also interviewing the clients. That's a great way to put it. So when you are looking to obtain clients, the other thing that you need to do is go in and talk with the auditor that was there before you and figure out why the client might have left that auditor, or the other side, maybe the auditor chose to move on. So some of the things that you'll be talking about are the management's integrity, the disagreements they might have over accounting principles or recording items. You'll communicate with management about who is charged with governing internal control and anything that might be a significant deficiency or cause a material weakness. And then understanding why they changed auditors. And finally, just communicating to evaluate management's integrity. Those are the reasons. So again, so along with the manager's responsibility and the auditor's responsibility and some of the underlying things regarding public companies, like if they are in accordance with the PCA OB responsibilities, we also have these other items you can include on the letter, including the arrangements regarding the audit, fees and billing, and then there's this item about obtaining information from predecessor auditors. And I just wanted to bring out that the predecessor auditor, again, finding out what's going on with that predecessor auditor is so key, because again, you have that engagement risk. So the engagement letter is very important. And again, you don't have to put the fees and billing in. This is a great question, but it's optional. Usually you would kind of give them an idea. Oh, and one other thing before we hop off, specialists. I was looking for that word earlier. Specialists. So sometimes you are going to go into a business you may not know something about it. You're just coming in as a third party. And there may be something like, I'm in the back of my mind, I'm thinking of drilling or mining, and there's something specific to the industry where you would take the time to inquire upon a specialist to verify certain information. And so there has been some debate about specialist users. There's been some literature about the use of a specialist and how that affects the audit committee. So again, that might be something that you would do if you're in a business that has a very specified nature. And so as you're in that step of obtaining and understanding, obviously you're not going to be able to go in as an expert, and that's where specialists might get used. So let's go ahead and look at the audit process and the steps within the audit process. This is going to come back to visit in chapter 7, so it's important. So this is something that, again, I think when we talk about the CPA, this is something that you should star for your list. If you're getting ready to prepare for the exam during this class or after this class, this is a star for your list right here. So the audit process includes planning the audit, obtaining an understanding of the control in its environment, which we'll talk about in the next chapter, assessing the risk for material misstatement, and designing further audit procedures, performing the further audit procedures, completing and then forming an opinion, and issuing the report. All right. This part right here, this chapter, is going to emphasize getting the client. And then the next chapter is going to be the internal control. All right. So here are the stages of the audit. This is also in your book. Again, I'd put a big star by it. Something you need to practice and understand and really get a good grasp on. I really have to commend the authors of your book and the way they laid this out. Absolutely one of the best audit books I've picked up. And the way that they organized this particular book is great. I really like this one. So going over here and looking at the overall audit. So you're going to develop your overall strategy and audit plan, including your client staff and any other CPA that you might use. The large audit. You're going to make the arrangements for specialists, and then on the first year audits, the first client, you're going to communicate with those predecessors and then establish the opening balances of financial statements and where you're going to start. Now, as you're going in and performing risk assessments, you're going to look at those analytical procedures that we looked at in Chapter 5 when we were looking at, I think we did one for accounts receivable for sales. We're going to look at those and we're going to benchmark those against industry standards to come up with a plan to decide whether or not we need to do a little more digging in this area. We're going to go and we're going to just walk the floor and look at how things are going. And then finally, you could make some other inquiries, including the legal counsel or an appraiser, valuation expert, and just research the firm and the business, including things from organizations' papers, even academic journals. And as you are obtaining your understanding of the client's business, you're going to look at that work chart and look at how competitive they are in their industry. Look at their accounting procedures, the ownership and capital structure, and their service lines. Capital structure, you might be looking at whether they how they outsource or whether they have full ownership of their machinery. Product and service lines, you may be looking at the different products. You may even inquire of the managerial accountant and some of the internal documents just to understand how the products work and how they sell. Critical business processes and internal control. That's all under the obtaining an understanding of the business. And then you're going to go and look at the regulatory factors, including things like how they relate to suppliers. I go back and look at the supplier that supplied heparin, which was a drug that, and I don't know if I've told the story of the class if I've had you all before, but there was a drug in 2008 that was outsourced to a foreign country, and it was a biologic that ended up, the circumstances of which the biologic was developed. The biologic, I don't know if you know what a biologic drug is, basically it's developed in animals. And so whenever you hear that on the news, now you know, oh, this is what a biologic is. And the animals that it was developed on were not living in sanitary conditions. So what happened is, because there was not that high level of quality from the supplier and it was a pharmaceutical got shipped over here, people got sick and died. And there was a huge lawsuit, big crisis, kind of called into question the nature of outsourcing, particularly in this particular line of industry. And so what happened was people started really researching and tightening up their supply chain. And so that's kind of the whole concept of customer relationships. Do they have one customer? Maybe they've got one customer that's responsible for 90% of the business. Well, that should be documented. So these are, again, some of the things. technological developments, and laws and regulations that they may have to maintain compliance with. Economic conditions. Currently, we are living under a situation where we have coronavirus. So the economic condition is definitely going to play a role in future audits of company and whether or not some businesses can operate as a going concern. Attractiveness of the entry. So this goes into that SWOT analysis. Strengths, weaknesses, opportunities, and threats. You could even run a little SWOT. All right, so let's go into understanding the client's business objectives. So you'll go and look at their objectives and their strategies, their operational actions that they have in place, and their business. So you're going to be looking at them, kind of doing a deep dive. You'll look at budgets, KPIs, key performance indicators, and variance analysis. So if you had me in cost, or if you've already had cost, you know all about budget variances. Are they favorable or unfavorable? And you always remember that unfavorable may just mean that they had more business that year, so you have to keep that in mind. Favorable may mean that they were cutting corners, so you have to look at that from a very discriminating. I always say that favorable doesn't always mean favorable. Segment performances. Do they have something that's dragging the rest of the company down, that's required to be there? How are certain areas doing? Is there an area that is an outlier that's overperforming the other areas, and why is it happening like that? Or an area that's an outlier that's way underperforming. Those are things that you want to look at. And then of course the balanced scorecard and any external reviews. All right, so the next thing we talk about is understanding the internal control. Obtaining an understanding of the business's internal control is an entire dedicated chapter in chapter 7. So we are going to talk a lot about internal control, and we're going to talk about what controls exist, who performs them, the various types of transactions, and what accounting records and supporting documentation exists when you are looking at the internal control. Now, let's look at the sources of information that you would get to understand the client's business. There's a lot of places you could go. One of them is going to be talking to management themselves, and then the other one is going to be looking at guides, journals, publications, obviously the annual reports and filings, prior tax returns. You could go into electronic sources like the FASB. If you've had me in intermediate, you know about the FASB very well. Very proud to say that. And then, of course, just walking in and talking to people, walking the floor, talking to the plant offices. And the analytical procedures, which we talked about in previous chapter 5, going in and looking at comparisons to industry benchmarks. And you can even run analytical procedures and run spreadsheets to look and see, like if you wanted to pull a curve and see how they're performing with regard to an industry economic curve. And then finally, the statement of cash flows. Do they have, very important that we look at the statement of cash flows as far as the industry's ability or the company's ability to continue on as a going concern. All right, so materiality is very important. If we've talked in classes before, we know the difference between counting a paper clip, which is immaterial, to counting jets, which are super material. So any part of materiality becomes a very important part of the audit. And so the idea is that you have to use a lot of professional judgment. But remember, when we talked about the chapter on professional liability, you have to use the judgment, but you need to think of it as judgment that a third party with your level of competence and ability would also look on and say, is that reasonable? You're going to look at both the quantitative and qualitative factors. And it's very easy for you to get caught up in the numbers and just run the quick analysis and move on, but you need to look at what's right in front of you and the qualitative factors that go into the decisions. you need to look at the materiality based on the the overall financial statement level and allocate that, and then evaluate that based on your audit findings. So for example, 1% of $1 million, or $10,000 to $1 million is a lot different than $10,000 to $100,000. Okay, so let's look at the definitions of materiality based on the FASB and the PCAOB. So the FASB says, and I'm going to read it right off the slide. I don't like to do that, but this is important. Information is material if omitting it and misstating it could influence decisions that users make on the basis of financial information of a specific reporting entity. So translated, it's material if it influences decisions. If somebody is going to change their mind, if this material is omitted, then it's material. Or if this information is omitted, then it's a material item that needs to be investigated. The PCAOB interpretation says a fact is material if there's a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. So if it has an alteration, a significant alteration on the information available, then it's material. So overall, if it's going to change somebody's mind and they would like to know about it, then it's material. Okay, so when you're going in here and you're designing further audit procedures, one of the things that you're going to be looking at as far as what can go wrong and how likely it's going to be going wrong, and then what the amounts are involved. And one of the things that the book talks about is tolerable misstatement. So what amount could you say, like 95% of this is correct? Let me just throw an example out. Let's say that you are checking for signatures and 95% of the checks have signatures on them. Out of 100 checks, maybe 2 or 3 pop in and they don't have the second signature. That would say maybe that 5% would be a tolerable misstatement, would be something that you don't want to investigate, because it basically says that, hey, we accept that not everything is going to be perfect. Again, you're going to be doing this in your audit design. The other thing that I wanted to bring out, and I think doing a previous slide and then I hopped off a slide, and I want to kind of circle back to that whole obtaining and understanding of internal control. One of the things that you want to look at within your understanding and your material misstatement risk is getting an understanding of the company's processes. So, the book uses some examples, including the manufacturing environment, understanding how raw materials are managed, stored, the processes of using the machines, assembling, packaging, the process used to create demand for products and services, so the marketing, and the process used to establish terms and billing, so the sales process, the delivering of goods. All of these things that are activities are going to be looked at in obtaining the overall understanding. And that's a couple slides back, but I want to go ahead and add it here. Okay. Okay, so for the rest of the slides, I'm going to record without video because a couple of members of my household have decided to make themselves comfortable around the keyboard. So in order to continue on with the lecture, we're just going to do it with sound only. And hopefully if this particular member decides to move on, I can finish recording the lecture with some video. But in the meantime, let's talk about responding to fraud risk. So the overall response to fraud risk you want to approach fraud with professional skepticism, and obviously you want to approach the entire audit with professional skepticism. But as you are going through the audit process and you are looking at the different areas of risk of fraud, you're going to be adjusting the way you look at the situation. If you find a significant risk, you're going to maybe assign different personnel and adjust the supervision. If you find that the audit is clean, everything's running on time, then you'll probably give the personnel, the lower line level personnel, a little more freedom and less supervision. If you find that you need to get involved with the audit and it requires a more senior person on the case, then you will obviously adjust your scrutiny. All right, so let's look at the overall response. So actually, let's go ahead and look at the consideration of fraud throughout the audit. All right, so when you're going through the audit, you're going to evaluate the results of the audit tests, and you're going to look for fraud. And as you are looking for fraud, you're going to adjust and communicate that fraud to senior management, because ultimately senior management is going to be sending that down to the audit committee and looking for a risk of material misstatements. So once you have obtained an understanding of the internal control, obtained an understanding of the client's business, then you're going to start designing the audit procedures. And once you've got that down, you're going to be, in other words, you're not going to go in for each client and have a boilerplate cookie cutter type audit plan. It's going to be kind of designed towards the client's business, and what you see is really going to drive what you end up doing as you are obtaining an understanding. So once you get this understanding, then you will design your tests of controls, your analytical procedures, and your tests of details. Now, here we go with some things. I'm going to circle these because, again, if you're looking for that CPA exam, these are a list of things that you should put on your note cards to go back and review. Also, I want to bring out the further audit procedures once you've got those understandings in place, the understanding of the client's business. Then you will design your substantive procedures for things that are materially relevant. So you're not going to go out and substantiate things that are not materially relevant. Example, counting paper clips. You're not going to be counting paper clips. You will, however, be verifying things like accounts receivable, supplier payments. Those are things that you're going to be looking at. Tests of controls where the auditor's risk assessment includes an expectation that the controls are operating effectively, or when substantive procedures alone are not sufficient. So again, that's how you're going to look at your audit procedures. The procedures are always tied back to the risk of material misstatement, and the overall responses when assessed risk of material misstatement are high. What do we do when we have a very high level of material misstatement? We're going to try to lower some of the other areas. So we're going to lower that detection risk and put together more procedures. We're going to have a heightened awareness and a heightened level of professional skepticism. We're going to put the more experienced staff on call, and we're going to assign more staff. We're going to have more supervision, so there's going to be more work done. Okay, so the audit documentation. The documentation that should be in the audit file includes assessment of risk, the results from the procedures, and the consideration of fraud. And the audit trail is a trail of evidence that links the original recording of the transaction and journal entries to, it links the original recording of transaction and journal entries to the ledger, to the financial statements. Now, there's two tests, and we're going to, in another slide or two, we're going to look at what those mean, all right? And there's a directional thing about them. And this is something that you should know. Again, I'm circling it. Think about your CPA exam. Tests for existence and occurrence. So that is going from the recorded amounts in the financial statements, in the ledgers, to the source document. So existence, put a little E, exist, is from ledger to document. That's how I remembered it. Okay, completeness is the other direction. And that's going from document to ledger. So, if it exists, that means that we would go back into the ledger that we found and then go back. So, for example, we find a balance in accounts receivable. We go back to the sales receipts. We go from the accounts receivable ledger down to the sales receipts. And that would be whether or not this accounts receivable is real, that's in our ledger. Were the sales made on time? Were the sales made at closing? Those would be some of the questions I'd be looking at. Completeness means, did we get it recorded correctly? We have this document. We got a list of purchasing documents. We got to go from those all the way to, did the items get received? Were they recorded in the general ledger as inventory? So we look at existence and we look at completeness. So in the existence, remember, we start with the ledger. We start with the ledgers. All right, we look at the balances in the ledgers. Are there overstatements? Did we record too much? So we'll walk back to the documents, right? Ledgers to documents. Right here, we'll walk back through the journals and down to the source documents, just like this. Okay. Now for completeness, all right, we're looking for understatements. Did everything get recorded? Then we'll start at the source documents and walk the transaction all the way up here to the ledgers. All right, this is something, I'm going to put a little star on it. You need to know this for standardized testing. Very important part of auditing. All right, the transaction cycles. So you may not know this, but when you were taking accounting 1 and 2, principles of accounting, financial accounting, you went through an entire transaction cycle, from sales and collections to acquisitions and payments to conversion. You may not have gone through a financing cycle, but you went through several transaction cycles when you were doing all those journal entries. And now this is going to come into play. As an auditor, you would come in and look at each of these different cycles and look at how the internal control is organized around each cycle. Is there a separation of duties? Are there controls? Is there safeguards in place? So here's an example of transactions affecting accounts receivable. And you can see here we have the beginning balance, and here's our sales and collections. So here's where we have our sales, where we debit our accounts receivable. Here's where we collected. Here's our sales returns and allowances that lowered our accounts receivable, partial uncollection, and then finally an ending balance at the end of the cycle. Now, within the audit plan, we also, in addition to looking at our our internal control and getting tests of controls and control risk, we're going to go out and deal with our substantive test portion, which is basically verifying the balances. And you can do both indirect and direct verification of income statement accounts. So, some of the areas that you would look at. Remember how when you were in Accounting 1 and you had to look at the effect of certain transactions on the assets, liabilities, and equity? That's all going to come into play now as you look at the various financial statement relationships between these income statement items. So, for example, revenue, you would be looking at the cash receipts, and you would look at the beginning and the ending balance sheet or beginning balances of accounts receivable. So the way you would want to verify that is by either verifying indirectly for the income statement item, you'd look at the right hand side of the equation, or you could use analytical procedures. Well, I know that there was one where we did, I believe in the previous chapter, sales to accounts receivable. Now, looking at the different ways you substantiate, you could also test transactions within the cash. All right. And then last but not least, you go in and look at the references from last year's audit papers. And then do substantive tests for current years. So each of these items, if you were going through revenue, you would go in and do calculations and then pull the receipts and then look at last year's audit papers and look at current year's accounts receivable. The relationship to the financial statement assertions and the audit. Remember the management assertions, and I accidentally flew by this slide earlier and I thought, oh, I hope it comes back, and it sure did right here. Remember, you need to know these assurances for the exam. I just want to throw that out there and make sure you've got these on your note card. All right, so again, here's a nice little chart. I'm going to let you read your chapter, and don't forget to check these over. This concludes my lecture for for chapter 6, and I've got chapter 7 up. Keep working. Make sure you fill in your participation package this week, and have a great rest of your